to start to trust my balance sheet. Okay, so the banks stop lending to each other, and when the lending wheel stops going around, everything stops. Now, what's happened subsequently is that in the US in particular, the Federal Reserve has stepped in and done all sorts of things. They've stepped in and said that they won't let Fannie Mae or Freddie Mac fail, and Fannie Mae and Freddie Mac are insurers of or issuers / insurers of mortgages. So the government has said that they won't let, or the Federal Reserve has said that they won't let those fail. They've also bailed out big investment banks that look like failing, which has never been done before. They've just stepped in and done it. Plus, they've set up a relief package for homeowners who are having difficulties. So I think that those measures tell you that the Western economy is not going to pot. The Federal Reserve and the US government will do anything to make sure that the wheels keep going around. And as a consequence of that belief, or that faith, you can see that once people have started to get that in their heads, this pricing differential has started to fall. And so it's getting much closer to normal levels than it was back in that really turgid period last year. Last week someone said, why are these numbers here negative? Well, that was really because in that period there, the Federal Reserve was saying that we will pay you, the Federal Reserve, American government in effect, was saying that we will pay banks to take money off us. Okay, so they were basically throwing money at the banks to say that we'll do anything, we're not going to let you fail. So what I'm saying is it's not all out of control. It's in control. People are, it's an ugly period. I'm really sympathetic that to everyone in the audience, because, you know, people's wealth has gone down. But having said that, it's not the sort of situation where it's just not sensible to say it's all going to zero and everything's completely going to pot. It's not. It's not. It's in hand, and the you know, that data shows you that it's in hand, and financial markets are starting to believe that. Now, on a much more local scale, something that we look at all the time is investment valuations, and some of these so if things are undervalued, that's another thing that stops the market falling, because people start saying, well, hang on, you know, why do I want to sell that when it's at such a low price? And some of the valuations that we see out there now are just, there's no other way to describe it, but they're verging on silly. Now, I mentioned to you earlier about the problems in General Property Trust, but those problems in General Property Trust are nothing compared to some of the real ugly things that have happened, right? And regardless of those, whatever is going on internally in there, the net tangible assets, which are the buildings that the actual value per unit of the buildings that it owns, are about $2.68 when the thing's trading at $1.60. Now, it doesn't matter how far out it doesn't matter how far out the valuers are in assessing this $2.68, but there's no way that they're that far wrong. So it's worth something more than $1.60, which is where it's trading at. Another one is Transurban CityLink, which is a toll road based in Melbourne, and it's a stock that I followed for a long time. Now, toll roads, you know with a fair bit of certainty how many cars are going to use the road every day, and toll roads have automatic CPI increases in them, so that every quarter the value of the money that the motorists pay goes up. So it's really, in a sense, an inflation index bond. So what you've got here is, of this thing that has predictable revenue streams, the net tangible assets are $6.09 and the price of the thing's $5.16. So you can go and buy this toll road. You can buy a unit in the toll road for less than the asset value. That's just unheard of. The hybrids, which most people have got some in their portfolio, their face value is $100, but many are trading at $80 or below. Now, the thing about that is that they all come with a promise to pay you back the $100. So, and the reason why that they've fallen down like that is, well, there's a number of reasons, but the main reason is that people have bailed out of these things holus bolus, or the market bailed out of it holus bolus, and what's that? And because these issues are not very big, there's not a real lot of shares traded, the prices of them gets driven down very, very easily. But lately, in the last week or two, with interest rates looking like they're going to be cut, hybrids come back in fashion and people start loading into them, and we've started to see the prices of hybrids drift up over the last couple of weeks. If you look at the banks, all the big banks, their average gross yield's more than 12%. Well, you know, that compares to a deposit of 8 or 8.5 or something. So you can actually buy a share in the bank and get 12% return at the moment. And finally, earnings multiples, which is the price divided by the profit per unit, are incredibly low. People say that you should, a rule of thumb is that you should expect the market to have a correction when the multiple is about 21 times, okay, 21 times earnings. Right at the moment, small capitalisation companies, so a company like the Rock is a small cap, a small capitalisation company is trading on about 6 times, and even the big well-known names are trading at 14 times, which is way, way below what a standard is. Now, what we're looking for is declining interest rates, which will help a lot. And what's going to lead to that is slower world growth. Now, up until a few months ago, everyone was saying that the world is, you know, going to continue growing at a fast clip. But now, especially in the last 2 months, there's been regular downgrades to expected global growth, and we only got some data across our desk late this afternoon saying that the growth in China was not going to be, well, expected not to be 10%, but to be 8%, which is a big drop for an economy like China. Now, America's hit the wall, England's hit the wall, Europe's slower, so all the Western economies are slower. Now, why is China booming? The main reason China's booming is because we buy stuff off them. Now, people say that China has, you know, it's got internal growth because people are moving to the cities. The only reason those people are moving to the cities is because people in the West are buying their stuff. And not only that, we've had the Olympics. $40 billion spent on developing the stuff for the Olympics. Now, with that all behind us, and with the West slowing and the Olympics over, China and India are slowing. And they are not going to support global growth to the extent that was previously thought by a lot of people. On account of that, commodity prices will start to fall, or are already starting to fall, and many base metals are way off their peaks, and oil is down about $25 a barrel now. And I mentioned the Olympics expenditure. So these are all things that point to slower global growth. In addition to that, and this is what the Reserve Bank's looking at, is consumer confidence has gone through the floor. You've only got to watch the news to see Alan Kohler saying, oh, well, look at the graph, the Westpac Confidence Index, it's just about off the chart. Business Confidence Index is exactly the same thing. Building approvals are tanking, so people are just, the money's not getting lent and people are not building houses. And as of the last week, the Reserve Bank has come out and said that they think the next move in rates is going to be down. So I'm expecting that interest rate cuts, and I've been saying this for a while, but it's only now that I think we're going to be quite confident we're going to be vindicated. Interest rate cuts are going to occur either late this year or early next year, and the market itself is pricing in 100% confidence in an interest rate cut for September. So those things should give you a lot of confidence that, that things will start getting better in people's portfolios. And in the meantime, even if it takes a bit longer than expected, there's plenty of income coming in the portfolios to generate the income that you require to live on. So a few departing thoughts. The current malaise in the market is cyclical. It's not the end of the world, and it's our job, everyone at CIPL, to manage through it. Falling interest rates will be very beneficial to our portfolios. They're heavily, the valuations of our portfolios are heavily dependent on the prevailing interest rates in the economy. Portfolios are generally down, and but as I said, income is strong, and we don't very often have to sell clients' assets to supplement income needs.